So, in our last Markets in Five episode, I had discussed the fact that September is widely known as really one of the worst months of the year. So, we're going to dive into the details and determine if we're going to have the September blues this year or not. Stick with me. My name is Brian Cannon, and welcome to Markets in Five. So, as always, before we dive into the details, let's talk about the market and where we stand. So, from a pure technical trend perspective, we're still very much in check, right? So, we're holding up major levels of support, this blue line here, and we're also holding various, the 20-day, the 20-day moving average here in the blue, and the 50-day moving average in the red. So, there's nothing from a trend perspective that screams, any sort of alarms. But, again, I'm going to go into a couple of things that leads me to believe that we just might be, the market might be getting a little bit tired, might be getting to a point that, we just need to be very, very careful, especially as we enter the nasty month of September. So one of the comparisons we really turn to when we try to determine if the market's turning is relative strength from consumer staples relative to consumer discretionary. So consumer staples are your have to have things, right? Your toilet paper, your cleaning supplies. You're going to buy those if the market's up, or you're going to buy those if the market's down. And so when we look at that relative to consumer discretionary are your nice to have things, right? Your luxury handbags and very expensive items that if the market was getting pounded, you might not feel like you need to go out and buy that luxury item. It might wait a little bit. So in a up market, the consumer discretionary tend to outperform, and in a down market, the consumer staples tend to outperform. And so when we look at those two sectors, in comparison, you can start to draw some interesting analysis. So just because the market falls doesn't mean that consumer staples are going to make money. It just means that they fall, generally speaking, less than the consumer discretionary type stocks. So here you can see before the pandemic last year, we had a break in the trend line on consumer staples, right? So there's a good sign to get out. But then when you look at the relative strength of consumer staples to consumer discretionary, you can kind of see that there was some major resistance here that couldn't get taken out here with these four pink arrows. And then when the market started to roll over, you saw consumer staples begin to dramatically outperform consumer discretionary. So they had broken through that level of resistance and started to outperform. So again, it doesn't mean that consumer staples are going to make money. It just means, generally speaking, they're going to lose less than consumer staples. So that's the type of thing that we're looking for now. And as it currently stands, we've got kind of a level of support, a level of resistance that we're monitoring. And if that gets broken and trend lines get taken out, then that would be a very clear signal to us that the market it's more than maybe just a pullback. It might be more of a larger drawdown that requires more attention. So another way that we really try to determine the health of the market or the direction of the market is, we'll see in this type of pattern here. You can see this is the S&P 500. And you can look at it on various different time levels. The market in general is fractal, meaning it kind of does the same thing at different levels and different periods of time. But if you look at kind of the peak to the trough, and you start to see this narrowing of the market. And so when the market narrows like that, and it kind of gets into this funnel type approach, and eventually it's going to break, right? And generally speaking, when you have this type of up market we've had, usually the break is to the downside. So again, that's something we'll watch and monitor. But and then when you bring that into a little bit closer level, you can see that it might have a little bit more room to run. So again, it just kind of depends on which time frame you're looking at. But generally speaking, this is something that we're paying attention to as well. So when that breaks, we just want to be prepared and be ready, and not necessarily look to ride the next market wave down. So in wrapping up, you can see there's a lot of signs out there that we're watching for, and again, we always use the weight of the evidence. We're not going to make a decision based on one or two factors. Will we have September blues? There's some signs that point to the fact that we might, but again, there's no guarantees. So we're watching it, we're keeping a close eye on it, and we'll keep you informed. But if you have any questions, by all means, feel free to reach out to me, and we'll see you in the next Markets in 5.